What if I told you that you can literally own a piece of India's biggest companies, Reliance, Infosys, or even Zomato? You don't need to be a billionaire or a business tycoon. All you need is one share. And that's how simple stock ownership really is.
Welcome to Trading with Krish. In today's video, we'll break down, in the simplest possible way, how stocks work, what ownership actually means, and how you can be part of it. Let's get started. Every company starts with an idea, but ideas need money to grow, to build new factories, hire more people, and create new products. So how does a company get this money? That's where investors like us come in. A company has two main choices. Option 1, take a loan from a bank. That means debt, interest, and repayment. Option 2, invite people to invest in the company by selling ownership slices. Those slices are called shares. Imagine a large pizza. When you cut it into slices, each slice represents a small portion of the whole. Similarly, a company divides its ownership into shares. Each share you buy gives you a piece of that company. When you buy even one share of a company listed on the stock market, you officially become a part owner. That means you own a small fraction of that business, along with thousands of other shareholders. When Infosys went public years ago, anyone could buy its shares. Early investors who held on saw the value of their shares multiply many times over, because as the company grew, their ownership became more valuable.
These shares are traded on stock exchanges, platforms like NSE and BSE, where buyers and sellers meet digitally to exchange ownership.
Now, the price of a share changes every second, and that's because of demand and supply. When more people want to buy, the price goes up. When more people sell, the price goes down. News, company performance, and even investor emotion, everything affects this movement. You can earn money from stocks in two ways. First, when the price of your share increases, that's called capital gain. Second, when the company shares a portion of its profit with you, that's called a dividend. Let's say you own 10 shares of HDFC Bank. If the company declares a 15 rupee dividend per share, you'll receive 150 rupees just for being a shareholder. You didn't have to do anything. That's the power of ownership. Of course, there's no reward without risk. Stock prices can rise and fall daily, and not every company succeeds. That's why short-term trading can be risky, but long-term investing in strong companies usually pays off.
Reliance shares were around 50 rupees in the year 2000. Today, they are now over 1500 rupees. That's a 30x return for investors who simply owned and held.
Buying stocks today is super simple. You just need a demat and trading account. You can open one on platforms like Grow, Zerodha, or Upstocks. Search your company, choose the number of shares, and click Buy. That's it. You're officially a shareholder.
You don't need lakhs to start. You can begin with 100 or 500 rupees, build experience, and grow from there. Every great investor started with one small step. Let's quickly recap. Companies issue shares to raise money. You buy those shares and become part owner.
Prices move with market demand. You earn from price growth and dividends, and in the long run, patience pays the most. Don't just buy stocks. Own businesses. Because when you think like an owner, not a trader, your perspective changes, and so do your results.
If this video helped you understand how stocks work, hit the like button, subscribe to Trading with Krish, and tell me, which company would you love to own a share of?